Let's welcome Shibani Sircar Kurian, the Senior EVP as well as Head Equity Research at Kotak Mahindra AMC, who joins us on the show. Hi Shibani, good afternoon. Good to see you in as always. Well, what's your thought process? We had a bit of a shakeout in the mid and the small cap space, say 15 days or so ago. Do you think that's done? And what is your view right now? What is your preference between the large caps in comparison to the small caps?
Hi, Nigel. Good afternoon. So what we have been seeing in the market is that from an overall fundamental perspective, the key drivers for the market remain intact in terms of economic growth and GDP, earnings, which have so far been fairly resilient across large cap, mid cap, and small caps, as well as the flows, specifically the domestic flows, which continue to be strong. As we have been stating, is that what we are looking at from a valuation perspective, if you look at large caps today are trading at about 11-12% premium to their historic average multiples, while mid caps are trading at about 14-15% premium, and small caps clearly are trading at a significant premium closer to about 39-40% as compared to their historic average multiples. Also, if you look at the movement in prices that has happened over the last 1 year, for small caps and micro caps, a lot of that price movement has been driven by multiple expansion more than their earnings growth. And therefore, the expectation in that segment is of a significantly superior earnings trajectory continuing going forward as well. And from an overall asset allocation bucket, we believe that risk reward still continues to be favorable for large caps vis-a-vis mid and small caps, simply because of the valuation differentials that we were discussing.
Shibani, hi, good afternoon. So, you know, what themes, if any, fresh ones that may come to mind, and considering we had a bit of a cool-off in the broader market, did you manage to pick up any fresh bargains? I know we can't talk stocks, but just in terms of, you know, pockets which have started interesting you now.
So I think, Surabhi, our themes continue to be more domestic in nature. We believe that domestic cyclicals continue to be better placed at this point in time. One factor that we are evaluating very closely is how private capex cycle starts to. As you know that from the infrastructure manufacturing space, a lot of the growth that has come through in the last few years has been driven by public sector capex, both central as well as state government. Incrementally, if you see signs of private sector capex picking up, that we believe will be a significant positive for the space. If you look at capacity utilization levels at a headline number, we are at about 74-75%. And if you look at the manufacturing PMI growth that we have seen in the fourth quarter so far, that is suggesting that capacity utilization levels are possibly inching up even further. So therefore, our belief is that anecdotally, the evidence seems to suggest that private sector capex should start to pick up as well. And therefore, from a theme perspective, the entire industrials, infrastructure, manufacturing space remains one which we continue to be positive on. Apart from that, the sectors that we have been positive on remain pretty much the same. So auto and auto ancillaries, cement, which is again a corollary to infrastructure and housing, and some of the larger private banks where we believe that valuations are favorable.
You know, just to follow up, Shibani, on this, I know you folks have been, you know, pretty much sticking to these themes for a while now, over a year and a half. I mean, the whole manufacturing, cement, and the capex play of it. The question is that do valuations still, you know, make you comfortable? Because a lot of these stocks on the capital goods side, for instance, or even power, etc., they've all rallied a lot. So if you were to put fresh money to work, are you still comfortable with capital goods valuations or some of these capex plays?
Yes, so you're right that the entire theme has worked very well. In fact, not just last 1 year, maybe last couple of years, and therefore valuations have become stretched in pockets. We believe that the runway for growth as such remains extremely strong. We continue to expect that the next leg of growth will come from private sector capex, and therefore that flowing through into various ancillary sectors which should benefit. We are mindful of valuations in pockets where, you know, the valuations appear to be stretched. But we do believe that there are adequate opportunities to play the theme. The theme is likely to be a multi-year theme rather than just a very short-term phenomena. What we also expect is that even from the public sector side, while there has been a lot of debate as to whether the government capex will continue, our belief is that post-elections, once the new government is formed, the focus will turn towards the budget. In the last few years, clearly what we have seen is that capital expenditure has taken precedence over revenue expenditure, and that is something that would continue. And therefore, you have a situation where both public sector as well as private capex should support the growth opportunity. And that we believe will be the key driver for the sector.
Since you brought up the subject of PSUs, there was this note that Nomura wrote on the Indian financial space, where they met with over 30 institutional investors in Singapore and Hong Kong during their marketing trip for India Financials. And they came away saying that they found increased interest for owning PSU banks amongst the long-only funds, which is led by confidence that the return ratios will improve, asset quality continues to remain benign, and also the fact that the investors agreed that PSUs are better positioned in the current tight liquidity scenario given their lower loan-to-deposit ratios, lower LDRs. Where would you stand on the PSU versus the private financial debate?
Yeah, so that's an interesting question. So if you look at the banking sector today, I think the entire liability side is clearly in focus. We've known that liquidity has been tight, and therefore deposit growth on an incremental basis has been lagging incremental credit growth now for 2 years in a running. And that's something that we have never seen in history. So therefore, banks which have better liquidity, better retail deposit franchise, and therefore the ability to grow loans out of retail deposits will be better placed. For the sector as a whole, you've seen that margins have come under pressure because your cost of deposits on an incremental basis have been moving up. And to that extent, in the near term, some of the PSUs, specifically the larger public sector banks, and maybe some of the larger private banks also, which have strong retail deposit franchise, as well as high liquidity coverage ratios, will be better placed. So overall, when we are looking at the sector, we are trying to identify banks and companies which have a strong deposit profile, which should help them in terms of managing margins better in this current liquidity situation. Overall, within the pack, we continue to believe that the larger PSU banks as well as the larger private banks fare better in terms of growth valuation dynamics vis-a-vis some of the mid-sized banks where valuations have clearly now caught up.
Okay, all right. Shibani, just hold that thought. As we speak, actually, the mid-cap index has moved into the red, and there are quite a few stocks that have moved low in the last few minutes. NBCC, pull up the intraday chart out there. That stock has seen a bit of a dive. You have, Pfizer that's moved a little bit lower. Bosch has moved low. So quite a few stocks. Canara Bank as well has come in for some profit taking. So some money being taken off some of those stocks actually from the mid-cap space. Final question, Shibani, what about the metal space? We had a technical call earlier today where Gautam Shah told us that he's expecting a big surge for metals. On the charts, it's looking very, very good. He believes that it's under-owned and they're going to come out of a phase of underperformance. Namely stocks like Hindustan Copper, Nalco, SAIL. How are you all placed on metals?
So Nigel, we have been underweight on metals as a pack, and that stance continues at this point in time. Globally, we continue to believe that growth remains a challenge, specifically so growth in China. We've seen many instances where there were hopes that there would be a policy push in China to revive growth. However, that has not come through. And from that perspective, we believe that this sector will remain extremely volatile in nature, and hence our stance overall in the sector continues to be underweight at this point in time.
Shibani, we leave the conversation here for now. Thank you very much for joining in. Enjoy tomorrow's trading session.